Beyond Meat is in a free fall. The stock is trading live at $1.23 and it is plunging, down a staggering 10.3% just minutes into the trading session. This isn't a slow bleed, this is a full-blown capitulation. The expectation, for the few remaining optimists, was that yesterday's third-quarter earnings report might finally provide a floor. The hope was that the recent wild meme stock rally it experienced in October had some basis, any basis, in reality. But what we are seeing this morning is the brutal, unforgiving reality of a market digesting what was truly said. And the reality is this: the company's guidance for the fourth quarter was so disastrous, so far below what anyone was expecting, that it has completely overshadowed a minor beat on revenue. This 10% crash isn't just a reaction, it's a repricing for survival. What's happening on the screens of every Robinhood stock trading enthusiast and every institutional manager at Fidelity is the consensus realization that the company is failing to find demand, and the path to profitability now looks less like a path and more like a cliff. The common belief, the story that so many people bought into when this stock was the talk of Wall Street, was that Beyond Meat was the next Tesla stock. It was seen as a technology company that was going to disrupt the multi-trillion-dollar global meat industry. The expectation was that its products would get better and cheaper, eventually crossing the line to be more appealing than animal protein. People setting up their first online investment accounts, perhaps using SoFi Invest or a SoFi robo-advisor, were told this was the future of food, a clean, sustainable investment that was practically guaranteed to grow. The reality, however, has been a brutal lesson in business economics. The reality is that Beyond Meat is not a tech company. It is a food manufacturing company in a deeply competitive, low-margin, capital-intensive business. The reality is that consumer demand, far from being insatiable, was a trend that appears to have already peaked. Consumers are price-sensitive, and in the face of inflation, the premium-priced plant-based burger is one of the first things to be cut from the grocery list. The expectation was a disruptive moat. The reality is a commodity product facing crushing competition from Tyson, Cargill, and every private label brand on the shelf. Let's dissect this morning's catastrophic move, because it is tied directly to the earnings report that dropped after the bell yesterday. On the surface, some headlines might have looked okay. The company reported third-quarter revenue of $70.2 million. The analyst consensus was only looking for about $68.6 million, a beat. But the EPS was a loss of 47 cents, missing the estimate of a 43-cent loss. This is where the story begins to turn. But the item that is causing this 10% collapse today, the detail that matters more than anything else, was the guidance. Management guided for fourth-quarter revenue to be between $60 million and $65 million. Wall Street was expecting over $70 million. This isn't just a small miss, it is a signal of a complete stall in the business. It tells investors that the terrible U.S. retail demand, which has been falling off a cliff, is not getting better. In fact, it's getting worse. This is what sophisticated traders using interactive brokers trading platforms are pouncing on. They see a company that has lost its primary market. And then there's the other shoe that dropped, a massive non-cash impairment charge of $77.4 million. This is the company basically admitting that its assets, its factories and equipment are not worth what they said they were. This is a direct result of slowing demand and scaling back operations, particularly in China. When a company takes an impairment charge that is larger than its quarterly revenue, it is a 5-alarm fire. It's an accounting admission of a failed strategy. For anyone managing Fidelity wealth management accounts, an impairment charge of this magnitude is a massive red flag that often precedes even more financial distress. This is the kind of detail that automated Schwab intelligent portfolios might be programmed to sell on immediately, adding to the pressure we're seeing. This isn't just a bad quarter, it's a structural break in the business model. We also have to remember the context of the last few weeks. This stock, BYND, was inexplicably part of a meme stock rally in October. It soared over 300% from its lows, fueled by retail speculation and short squeeze chatter. People on their Robinhood app were piling in, seeing it as the next GameStop. The expectation was that this retail frenzy could force a new narrative. Today, the reality is setting in. That entire rally has been exposed as having zero fundamental backing. The drop today is wiping out the last of those gains, a final, painful rug pull for anyone who bought into that hype. The recent debt-for-equity swaps have also caused extreme dilution, as one analyst put it, flooding the market with new shares and crushing the value for existing holders. When you check your Fidelity mobile app and see this kind of drop, it's a reminder that fundamentals, or in this case, a complete lack of them, always win in the end. This isn't Nvidia stock, which is growing profits. This is a company whose core U.S. sales are in a tailspin. For those who are newer to this name, perhaps just starting their self-investing exploration, Beyond Meat was the poster child of the plant-based food boom. It went public in 2019 to massive fanfare, becoming one of the most successful IPOs of that year. Its products, like the Beyond Burger and Beyond Sausage, are made from pea protein and are designed to mimic the taste and texture of real meat. Their strategy was brilliant. Get the product placed in the actual meat aisle, not the vegetarian freezer section. They secured high-profile partnerships with fast food chains, and the story was electric. It seemed like the perfect growth stock, a story that felt as big as Apple stock in its early days. But the company has never been profitable. It has burned through cash at an alarming rate, and the competition it inspired has eaten it alive. The partnerships with places like McDonald's have largely fizzled out, failing to become the nationwide blockbusters the company needed to achieve scale. The past performance was a story of hope. The recent performance is a story of cash burn. This brings me to a question for everyone watching. We've seen the hype, and now we are watching the collapse. Comment below with your thoughts. Do you think Beyond Meat will be acquired for its brand name, or do you believe it is heading for bankruptcy within the next 12 months? Looking forward, the outlook is incredibly bleak. The market is now looking at this as a pure survival story. The company's balance sheet is a mess. As of the last full report, it had a little over $100 million in cash, but it also has a stockholder deficit, meaning its liabilities are greater than its assets. This is a state of negative equity, a very dangerous place for a public company to be. The cash burn is so high that analysts are now calculating how many quarters it has left before it simply runs out of options. Analysts are running for the exits. We've seen a slew of sell and underperform ratings. TD Cowen has a price target of just 80 cents. This isn't investment help you can ignore. The professional community that uses interactive brokers trading platforms is likely building significant short positions, betting on the price to fall further. The Fidelity ETFs and Fidelity mutual funds that are forced to hold this as part of an index are likely selling any discretionary shares they have. Even SoFi ETFs focused on future of food themes are probably liquidating their positions to stop the bleeding. The only bull case left is a buyout, that a larger food company might step in and buy the brand for pennies on the dollar. But at this point, they might just wait for a bankruptcy filing. In the end, the brutal narrative of Beyond Meat, highlighted by this 10% crash to $1.23, is one of the most stark examples of expectation versus reality we've seen in years. The expectation, fueled by IPO mania and a powerful story, was of a tech-like disruption of a legacy industry. The reality, revealed by yesterday's disastrous guidance and massive asset write-down, is that of a failing food manufacturer with a broken balance sheet, shrinking demand, and a product that consumers have decided is a luxury they no longer want. The meme stock rally was the final gasp of hope. Today's market action is the sound of reality taking over. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.